Good evening, everyone. Time for another silver update. This is the weekly chart of silver provided by netdania.com. You can click on the link below. This is a momentum index, momentum study applied to the silver chart, and I've drawn some lines indicating the slope of ascent out of the correction. Now you can see the first one resulted in a breakout and the run up to the Bear Stearns top. That was this first line. The second line marks the bottom of the 2008 collapse, and then as we approach the zero line, you can see we crossed over, and that's when we get our huge breakout here. The last line that we have here is actually a steeper slope of ascent here in the recovery of momentum. You can see we're just at negative 0.69, so we're about to cross over and go positive. Will we get a move like this, or will we get even a larger move? It's quite possible that we could actually get a larger move. The size of these gyrations that we're seeing are so much larger that we could get a larger move to the upside, and it's quite possible that we're still growing exponentially in these types of moves. So that seems to be what the momentum is indicating. We also could get a turn down here, of course, when we reach this line and correct some more. That would be a bearish test down to this line. Of course, a breakthrough would probably be a test of 21. Will the powers that be allow that to happen? Only they know, and that gets to some of the questions that we have for the night. I want to go through a number of questions. Before I do that, though, I want to take a look real quick at the Bitcoin chart. You can see we're running a breakout on Bitcoin's finally has gone to 11.2, and this is a 10-day. If you pull out to all data, you can see that it's broken out above this old resistance, and it's testing now this last time that it spiked. So it's very clear that Bitcoin's epitaph was written far too early, and we actually could test this 30-something number. Will there be a lot of Bitcoin millionaires? We'll have to wait and see, and I'm going to come back to this when we talk about one of the questions. Now, back to Knight Capital. I wanted to bring out a couple more things here. First of all, this is if you followed the story, Knight has pretty much been destroyed, although there's been some hints of some white knights coming in and saving them now, and extending some loans so they can keep going. But this is the latest from today, and this is a story about the software glitch. And of course, we never really get any details about this software glitch. It's a lot like the flash crash. They just never really tell you much. We just know it's a software glitch, and we heard some other details saying that, well, it bought when it should have sold and sold when it should have bought, and it lost a whole lot of money. I've already covered the fact that the SEC only decided to reverse 6 trades in 6 stocks, and then apparently Knight will be responsible for the rest. So it's all kind of very suspicious. And then there's actually a mention of an interesting fact here that I didn't find in any of the other articles, and that's about the testing of the systems. Now, it turns out that Knight was testing, or at least it is rumored that Knight was testing some software. And read this and get down to the key point. Outsiders question why Knight did not pre-test the new software more assiduously, and why the bad trades continue to be generated for more than half an hour instead of being shut down by internal systems almost immediately. New York quantitative hedge fund owner Roy Niederhofer said that there was no excuse for Knight failing tax sooner. This is like a nuclear reactor or aircraft, said Niederhofer, whose RG Niederhofer Capital Management uses Knight. There has to be some way of seeing the state of the whole system. Trading system glitches often arise with the installation of new systems or computer code. But experts said that market participants constantly need new systems to accommodate new rules and changing customer demands. For example, many trading systems were modified this week to conform with a new retail order trading system introduced at the New York Stock Exchange and to accommodate a French securities transaction tax that took effect on Wednesday. So that's very interesting. Now, what is a transaction tax? If we go to Wikipedia, we find out that this is actually a Keynesian idea where they can tax individual transactions. A financial transaction tax is a levy placed on a specific type of monetary transaction for a particular purpose. The concept has been most commonly associated with the financial sector. It is not usually considered to include consumption taxes paid by consumers. A transaction tax is not a levy on financial institutions per se. Rather, it is charged only on the specific transactions that are designated as taxable. So if an institution never carries out taxable transactions, then it's never subject to the transaction tax. Furthermore, if an institution carries out only one transaction, then it will only be taxed for that one transaction. As such, this tax is neither a financial activities tax nor a bank tax, for example. This clarification is important in discussions about using a financial transaction tax as a tool to selectively discourage excessive speculation without discouraging other activity, as John Maynard Keynes originally envisioned in 1936. So, very interesting. It turns out there's a connection between a French transaction tax being introduced and Keynes's idea of using that tax and the New York Stock Exchange modifying its systems. Are we entering a period where they're going to begin taxing the algos, the HFTs? Pretty much a transaction tax, if that was what they used, would shut down the HFTs and algos, because if there was a tax charged for every time the trade occurred, then high frequency trades would generate so many taxes that they would be effectively shut down. So another interesting take on that one. I don't know if that is going to turn out to be the case, but the fact that the French securities transaction tax took effect on the same day that the software glitch occurred in Knight doesn't seem to be a coincidence. Now let's go over to the questions, because there's a number of questions and I wanted to delve into them a little bit. They're very good questions. The first one is the Nixon shock, and this is from iDoc, and he says, "Hi brother John, my question concerns the U.S. abandonment of the gold standard in 1971. If I understand correctly, the gold was leaving the U.S. Treasury in droves and moving overseas because the U.S. had printed too many dollars and foreign central banks were sending our paper back to the U.S., exchanging them for gold at $35 an ounce. So in order to prevent a run and depletion of the Treasury's gold, Nixon closed the gold window. Would it have been better for the nation if Nixon, instead of closing the gold window altogether, had devalued the dollar against gold like FDR did in 1933 and changed the exchange rate to maybe $70 an ounce to stop/decrease the gold outflows, but still keeping the gold backing? Also, what good was the gold standard, gold exchange standard anyway, if the government could still overspend on the Great Society programs in the 1960s and the Vietnam War and print all those extra paper dollars? Isn't gold backing supposed to prevent deficit spending in the first place? And if so, why didn't it accomplish that under the Bretton Woods Agreement? Were we cheating the gold standard? Okay, so A couple of questions here. Would we have been better off as a nation? I don't know. Better off as in what? Would we have gotten as rich? I don't know. If we wouldn't have had a petrodollar standard, if the world would have been under a free-floating gold standard, international gold standard, would the world have been better off? My guess is probably so. The suppression of other nations using the petrodollar standard, the petrodollar recycling that came about. Now you have to remember that the gold never really flowed out of the United States. The London gold pool, which broke at that time because of the French demanding their gold, that was just one country, and at that point the price of gold was let loose. Now, even though gold rose significantly, and we've had stories recently now about audits of the Fed's gold, one broke today, you have to remember that these countries, even though they had the ability to demand their gold, exchange their dollars for gold, the gold was still stored in the United States. So the system was in no way a system, the ideal type of system of international gold standard, where nations who import too much end up running out of gold and have to begin exporting. That wasn't the situation that we had. We had and still have a U.S. dominated system, whether it's gold or the petrodollar, the oil, and it's not a free trading system. I think both of those systems are breaking down, and the cracks are appearing on those systems. So hopefully that clears that up a little bit. The next question, Prechter interview on the blog. Hey, Brother John, this is Viper99. Last week you had a clip on the blog with someone trying to challenge the grandfather bear, Robert Prechter. The interviewer did not even make a dent into Prechter's argument about holding dollars rather than precious metals. Prechter's main point is that the U.S. and all governments will simply default on all their debts. Banks will default on loans. Everyone defaults on everything. Paper becomes worthless. Bonds, treasuries, derivatives, and even money in banks. There will be few dollars left after this incredible default, and whoever is holding them will have the greatest buying opportunity in a lifetime. Prechter also said he would buy gold 10 years ago, which will not help now in the $1,600 an ounce range. Here is the nagging question I have. How do you know he is wrong? He makes a good point about the Fed knowing that kicking the can down the road is not going to work forever. They must have an exit strategy other than crashing the world economy. The world cabal must have a plan. I believe the silver fundamentals and knows manipulated paper form, but for some reason I still worry that Prechter is correct. Can you relieve my worries with some information? Am I missing or not understanding something? Well, that's a lot of questions loaded in there, but first of all, as I've said about Robert Prechter before, Robert Prechter would be lucky if he could compare with a stopped clock, which is at least right twice a day. Robert Prechter has never been right. He's always been wrong. Now, this point about holding dollars, I don't know where you're going to hold the dollars. Right here it says banks will default on loans. Everyone will default on everything. Even money in banks will become worthless. So I'm assuming that you're talking about dollars stuffed in your mattress. And that's all fine and dandy until they devalue the dollar. So and you can probably guarantee that if these things happen, they're going to have a dollar devaluation. Then all of a sudden, your dollars that are stuffed in your mattress are worth half or less than that. So the idea is there will be these few dollars left, and whoever's holding them is going to be really rich. I just don't buy it. Now the next point, he said that he would buy gold 10 years ago. Will not help us now at $1,600 an ounce. Well, the fact of the matter is he didn't buy gold 10 years ago, and he didn't recommend buying gold 10 years ago. I bought gold 10 years ago and recommended buying gold 10 years ago, and now he's trying to, I don't even know what he's saying. That's ridiculous. He's just been wrong for 10 years straight. Here's the nagging question I have. How do you know he is wrong? Because he's never been right. Maybe at some point he'll be right, but up to this point he's never been right. He makes a good point about the Fed knowing that kicking the can down the road is not going to work forever. They must have an exit strategy other than crashing the world economy. Well, actually, Prechter's bet is that they will crash the world economy. That's his deflationary scenario, where they crash everything and those holding cash win. So, yeah, it's just not to mention the fact that Elliott wave stuff, except for the fact that you observe that things move up in waves 3 and down, or up in 5 and down in 3, maybe has some merit, but for the most part, the predictability and the stuff of the Elliott wave, the accuracy of that stuff is just, it's garbage. Next question might be a silly question, but this is Austin. One hears over and over that if a country's currency is valued too high, it negatively affects exports. If a country's currency is high, if one is selling their product abroad, why not just sell it for less? It must be simple, but I don't get it. Now, this gets back to the international gold standard. It also gets back to trade deficits and currency values. You're always hearing in the news how so-and-so has an unfair, China has an unfair trade advantage because their currency is artificially, it's undervalued, they're holding it down. Or, you know, I've talked about the Swiss, how they went ahead and pegged their currency to the euro because they were trying to protect their exporters, because the appreciation of the Swiss franc would make their goods so expensive they wouldn't be able to sell them all overseas. As I said many times, these arguments are just a bunch of nonsense. It's all relative. China, for the most part, is an exporting nation and exporting manufactured goods. That means that China has to run a bunch of factories, and that means that China has to buy a bunch of raw materials and energy. So those are the inputs to their manufacturing, and those inputs cost them money. They have to import those and buy them overseas. So the stronger their currency, the cheaper they get those inputs to their manufacturing. Then when they try to sell it, of course, if their currency is stronger, then that means it's more expensive. It all works out in the end, and that's why these arguments about everybody devaluing and that everybody's going to help their economy, the beggar thy neighbor sort of stuff, it never works. Ultimately, you want to try to have a strong currency. You want to inspire confidence with investors to come and invest in your currency, to invest in your country, and to attract capital to your country. And I think that's going to be the next move with China. I think they're going to strengthen the renminbi and ultimately try to attract a lot of foreign capital and make it a convertible currency, and then take over as the most powerful nation and most powerful currency in the world. And next question is big fan, big question. This is from Matt Brink. Hello, Brother John. As you know, this country is now pre-Nazi Germany with tyrannical dictators in control. I'm a silver stacker, no gold. My mix has been bullion, eagles, private with junk. I am concentrating on private bullion now. Silver bullion is silver bullion. I feel it doesn't need the indoctrination of authenticity by USA Illuminati symbols. My question is, my wife and I want to leave this horrific country before we cannot leave. Do you or can you advise on how to get precious metals out? I know that any cash over $10,000 must be declared on international flights, but what about silver and gold? Will they let us take that? I read the horror story of the poor fellow going to Panama via Mexico with 151 gold coins not declared. He may have declared them with American Panama but not Mexico. They stole his coins, saying he was money laundering or supplying cash for illegal gun purchases. Soon the small arms treaty will pass here, and we'll have to hunker down for the second revolution when they come for our guns, and most likely our precious metals. If Ron Paul can't win in Tampa, we're doomed to repeat history. Depopulation is in high gear already, but people don't seem to realize this. Thanks for reading my lengthy first question ever. So this is a real tinfoil hatter there. I'm going to address mainly the issue of taking gold out of the country. You have to make a declaration to the country that you're going. There are a number of stories. If you want to go to Kitco, you can find them. You can also Google search for them. There are a number of people who have transferred their gold and silver to other countries. One of the gentlemen transferred it to Australia, another transferred it to New Zealand. You have to make sure that you've cleared it with the country that you're going to. I don't know about this passing through Mexico. You might not want to pass through Mexico. But as I pointed out many times, all of this is now irrelevant. And the reason why it's irrelevant, of course, is because of Bitcoin. Because as long as Bitcoin trades in all of these currencies, then it's just simply a matter of selling your gold or silver, transferring it into Bitcoin, locking it in an encrypted file, memorizing the password, moving overseas, downloading your Bitcoins, repurchasing your gold and silver overseas. So that horse is already out of the barn. It's just it's all over but the shouting. And of course that's the way governments are with encryption. At this point, encryption is a horse that's out of the barn. If you remember, if you were in the IT industry back in the 90s, at one point in time it was a federal offense to export a copy of Internet Explorer on a floppy disk, and you're actually was considered exporting munitions grade war materials. Now, of course, that ultimately is an absurd argument, and of course encryption is now available to everyone. I've covered that on other videos regarding Zimmerman and the PGP, etc. So that just the same way that encryption is a horse that's already out of the barn, the Bitcoin as well is a horse that's already out of the barn. And ultimately what that means is that capital controls is pretty much a thing of the past. And I think going forward, as there are more encrypted currencies and even things that we can't imagine, there are going to be ways to carry out intellectual wealth. So I think that, you know, wearing a belt of gold coins, etc., is probably going to be obsolete. It seems like the powers that be, they're losing the technological war simply because technology is moving so fast. Even though it's their method of control, it's also a method of freedom. So a great, tremendous struggle going on. Of course, one of the big struggles is their attempts to control the prices of precious metals, because of course precious metals give lie to the fact that their paper currencies are becoming worth less and less every day. So that's the user questions, and hopefully I addressed those. I didn't have a chance to go into any of the deals or anything, but still at 27.8 with a rising momentum, it's still a very good time to stack, and we'll talk to you next time.